guys, welcome to accounting. Today we are going to talk about preparing T accounts again, and we're also going to look at something called a trial balance. Now I have taken some transactions here that we have been working on before, and I wanted to show you we're going to be preparing the T accounts for them. So what we did was we took transactions from the Lawson company, and they incurred the following transactions during June, and we're going to say June 2020. So let's prepare T accounts for these transactions. Notice that I'm going to scroll down here and show you that the accounts that we are preparing are cash, accounts payable, Stan Lawson capital, supplies, service revenue, office equipment, salaries expense, truck expense, and utilities expense. Now notice one thing that I wanted to point out. When you're listing them, remember our accounting equation, assets equals liabilities plus owner's equity. That's how these are arranged. Notice all of your assets are here together. Here is your liability, accounts payable. Here is your owner's equity account. And here are your revenue and expense accounts. You know, we use these accounts when we prepare our income statement. And they always, after you prepare your income statement, it goes to the statement of owner's equity. So all of your equity accounts are here. So let's look. These have already been prepared, but I still want to go over the transactions. The first one is Stan Lawson invested $6,000 in his new cement finishing service. So we know that Stan Lawson invested $6,000. So we are going to increase cash by $6,000, and notice we put it on the left or the debit side of cash because cash has a normal debit balance, and to increase it we would have to put it on the debit side. And also notice that we are identifying each transaction with the letter. Now normally we use a letter because if we use a number, sometimes in writing the numbers they would get jumbled up with the amounts. So to be clear, we're using letters in these. So our debit side of the transaction is we have increased cash $6,000. And we know that for every debit we have a credit. So we look over here. Here's the other side. We have increased the capital account. And to increase capital, we credit it or enter it on the right side. Remember, debit and credit just mean left and right. They don't mean increase and decrease except when you talk about what type of account it is. So since capital or owner's equity has a normal credit balance, to increase it we are entering it on the credit side or the right side. And notice this transaction has always also been identified by the letter A. That way you can match your transactions when you're coming back through. All right. Now, the next thing we do, purchase supplies for cash. That's transaction B. So again, here is B. We are debiting it because it's an asset. We identify it with the letter. We paid cash for it, so we reduce cash or credit cash for the same amount because for every debit you have to have an offsetting credit. And we also identify it by the same letter so we can match the transactions. Transaction C, invested a used truck valued at $5,200 in the business. So we know also that is like investing cash. So we are investing the truck. The truck is an asset. So we are debiting the truck for $5,200. We have identified it by the letter C, and also we are crediting capital because Stan Lawson put the truck, his personal truck, in the business. So that increases his owner's equity or his capital account. So we are crediting it to increase it. Now, going to transaction D, we purchased office equipment on account for $800. So we are increasing office equipment, and we are also creating a liability because we are purchasing something on account. So office equipment, we have created the account. We are increasing it on the debit side because it is an asset. We have identified it by its transaction letter. Now we have to increase or create the liability. So accounts payable, because it's a liability. Liabilities have normal credit balances. So we are increasing it $800, and we have identified it by the letter. And notice we purchase office equipment on account. Transaction E, received cash for services rendered, $125. So if we have received it for services rendered, we're increasing cash. Here is our entry here. Transaction E, we increase cash. It is a debit for $125. So services rendered is our service revenue. So revenue has a normal credit balance. So to increase it, we will credit it $125. And you notice here is our transaction letter, so we can match it to the other one if we need to look back on it. Transaction F, received cash for services rendered. That's a duplicate transaction, just like the one, just like the letter E. Letter F is done the same way. So we increase cash. We're identifying the transaction with the letter. We're debiting it $250 to increase cash, because to increase cash is to debit it. And then we are increasing our service revenue $250 on the credit side, because for every debit we need a credit, and we have identified it by the letter. The next one, we purchased gasoline and truck parts for cash, $68. So this is transaction G. We purchase it for cash, so we are going to be reducing cash. That means we credit it. So we enter G on credit for $68. Credit just means that we are reducing cash because it has a normal debit balance. So to reduce it, we have to put it on the credit side. And we also have to do the expense. So here is truck expense, $68. Now, it's not an asset. You bought a truck repair, let's see. Let's look at it again. Gasoline and truck parts. That is not an asset. That's an expense used in the business. So you're going to call that truck expense. You're not going to put it over here with truck because it's not an asset. It's an expense. So, and again, expenses have a normal debit balance. So you will label it transaction G and enter it on the debit side for $68. Transaction H, paid salary of assistant, $350. We know the key word there is paid, so that's going to come out of cash, and salary will be an expense. So we'll see in cash, transaction H, we credited $350 because we're paying cash, so that will reduce our cash, and then we have incurred salaries expense. So we're going to enter it on the debit side because we have to increase salaries expense. So here is transaction H, and it is a debit for $350. Transaction I, received cash for services rendered, $300. So that one, we received cash. We're going to be increasing cash, and we're going to be increasing revenue. So again, transaction I, you can see it here in your cash account. You've identified it with the letter I. We're increasing or debiting cash for $300. And then in service revenue, same thing. We're crediting it because we are increasing it. So there's the letter I to identify the transaction, and then we are making a credit entry for $300. And remember, for every debit, you have to have a credit. They have to balance. So make sure that you always have two entries. Okay, transaction J, we're almost finished. Paid utility bill, $292. Okay, we are paying, so that will affect cash, and we're paying a bill, so that is going to be utilities expense. So we can see here in transaction J, we credited it because we've paid cash and we're reducing it $292. And you can see here in utilities expense, we have debited the utilities expense because we're increasing it. Expenses have a normal debit balance. So here is transaction J for $292. Here is the debit and here is the credit. Now the last one we have is another, we're paying the salary of assistant. So we know paid is going to impact cash. We're going to be reducing cash, and we're going to be debiting salary expense. So if we look at letter K, it's here in cash. We're crediting cash because we are decreasing it. So we're crediting it for $350, and our offsetting debit is salaries expense for $350. Now, that's all of our transactions, but if you look at our T accounts, you will notice that there is more information on the T accounts than we have done. So, for example, let's take the cash account. You notice that there are 3 extra numbers at the bottom. This is called footing the account, because for every T account here, you have to get the balance in order to prepare the trial balance.